Summer volatility continued last week when the S&P Global came out and downgraded banks, just like Moody's had done a few weeks ago. However, that was almost insignificant news in comparison with the two big catalysts this week: Nvidia's earnings on Wednesday and the Federal Reserve Symposium on Friday. Nvidia once again blew away all expectations, blowing out the top and the bottom line and giving incredible guidance, raising revenue from $12 billion to $16 billion, which no one on the street was expecting. For the past quarter, Nvidia reported a record $6.7 billion in net income, an increase of 422% from the same time period last year. And although Nvidia rocketed 10% in after-hours trading, it ended up rolling over because this is what's called a sell the news event. Investors and traders headed into Nvidia's quarter expecting it to beat. And when it did, that meant the news was done, and it was time to take profits. On Thursday, Nvidia ended up finishing flat with only a 0.1% gain over the previous day's close, and ended up actually finishing the week down from where it was before it reported earnings. Without Nvidia's leadership, a lot of strategists believe that the market could be extremely volatile in the upcoming week because Nvidia is no longer the one to hang your hat on. On Friday, Jerome Powell came out and spoke from Jackson Hole, Wyoming, and said pretty much exactly what we thought he would say last week. He announced that the Fed is seeing progress against inflation, but inflation still remains high. So while they're going to be data dependent, he's reserving the right to raise interest rates multiple times as we go forward. At first, the market sold off based on Powell's initial comments, but as he continued to speak and walked that line between hawkish and dovish, the market started to rally and finished Friday up. Next week is the last week of summer, and that means there's still low trading volume in the market, which could mean we're going to see volatility. There are a number of different catalysts that could move the markets one way or another next week. On Tuesday, we get the job openings report, also known as the JOLTS report, as well as consumer confidence, where we'll get to see exactly how confident the U.S. consumer is. If they are less confident, since our economy is completely dependent on us consuming, it could be bad for markets. On Thursday, we get the personal consumption expenditures, or PCE index. And this is the Federal Reserve's favorite gauge of inflation. Depending on which way this goes, it could be either bullish or bearish. And on Friday, we get the U.S. non-farm payrolls report for August, since it is already September 1st. In addition to that, we'll get the ISM manufacturing index, which will show us how much manufacturing is going on in the United States right now. The combination of low trading volume, a number of different catalysts, and the fact that it's the end of the month means we might see a lot of volatility next week as firms decide to reallocate as they get ready for the fourth quarter starting on Friday. After an incredibly exciting week last week, Bitcoin actually kind of maintained a bit of calm demeanor this week. Initially, Bitcoin retreated, but it made a higher low down here at $25,368. And this is a bullish sign. If you want to see an asset recover, you want it to see higher lows and higher highs going forward. On Wednesday, when it rallied higher, it hit $26,800, slightly below the bounce that it saw after last week's sell-off. This means that Bitcoin is very distinctly trading in a range now. We needed to either break through that $26,800 on the upside to see a bullish rally, or it needs to break down below $25,368 to see further bearish downside. As long as it remains trading between these two prices, it's just going to be a trader's market. If you're likely to trade, this is the kind of thing you want to see, because in all likelihood, it could stay here for quite some time. If it respects the bearish parallel channels that it's been reacting to for the last couple of weeks, you can see that we can move out here and see around mid-September is when it would impact. However, in my opinion, I think the volatility is going to kick in before then, and we'll see a break either further down or up to the upside before the mid-September area. If Bitcoin breaks bullish, the next level of resistance is up here at $27,250, where you can see there was a significant amount of price action in the past. After that, we've got $28,575, then $30,419, as well as the high from 2023, which was $31,837. If Bitcoin breaks bearish, the next level of support is that $25,368 mark, followed by $25,150, which was the bottom of the sell-off. However, I don't think that'll hold. If the immediate support breaks, I believe we'll see a break of this support as well. That leaves a couple of options. Either we've got the bearish channel that you see here, which gives us a new level of support slightly below at $24,672. We have this trend line that I've been using for a couple of years that's at $24,100. And then we've got support from the past at $23,944. After that, the next key level of support is down here at $22,000, followed by $20,627, and then the low of 2023, which you can see down here at $19,300. The bulls and the bears both have their own arguments for Bitcoin. The bulls believe that we're going to see it rally from here and make new all-time highs. However, a bearish report came out from an analyst last week who thinks we'll actually see Bitcoin pull below $10,000. Now, personally, I don't think that's going to happen, but if it did, it would be an amazing buying opportunity. Over in my investments in play portfolio, this week's winner was Tesla, which had just become so oversold that it was due for a bounce. Tesla ended up rallying 10.76% and won the week, being the biggest winner in the entire portfolio. As I said a few weeks ago, when Canopy growth was the biggest winner, that it could turn around and just give back all of the gains that it saw, because it is a penny stock now. And even though it had good fundamental news last week, this week it did exactly what I thought it could, and gave back not only the gains that it saw last week, but the gains it saw previously too. It's now below where it was several weeks ago when it was first the winner. The cannabis sector remains under selling pressure, and there is no sign of it stopping until we see a catalyst from Congress to pass the Safe Banking Act. That's nowhere on the docket right now. So Canopy growth sold off with the rest of cannabis this week, dropping 13.53% and being the week's biggest loser in the investments in play portfolio. Over in the speculation in play portfolio, another penny stock was this week's biggest winner, my junior gold miner. Golden Minerals rallied 6.79% this week. This wasn't just a penny stock bounce. There was actually good fundamental news. It looks like Golden Minerals may have saved itself from delisting. At the high point of the move, Golden Minerals had actually rallied 30% in a day before pulling back and finishing the week up 6.79% as the portfolio's biggest winner. The week's biggest loser is now a 2-week-in-a-row loser, and that's Virgin Galactic, which dropped another 11.19% this week. Virgin Galactic continues to crash land, and this is one of the most speculative positions that I hold. I'm playing with the house's money, and I will keep putting profits back into this position, but if I was starting a new position, I'm not entirely sure I'd even get in. It's hard to know how much longer Virgin Galactic has for this world. Over in my pandemic portfolio, Digital Realty Trust is one of the more interesting positions. It is a real estate investment trust, but because it has exposure to data center, it kind of has an artificial intelligence kicker. Digital Realty continued to rally and triggered my next selling target this week with a sale that went through on the 24th at $130.31, where I sold 8.5% of my position. The sale locked in 16.35% in gains and lowered my per share cost 1.52% down to $110.30. While I do like Digital Realty for the long term, real estate investment trusts are really tricky right now because we're in a high inflation rate environment, and they don't really succeed that well in that kind of environment. Accordingly, I am managing my risk very tightly with Digital Realty, and my next sell target is at $143.52, just below a past point of resistance that Digital Realty has seen many times over the years. As for adding back to this position, it will have to sell off significantly. My next buy target isn't until $86.76. A bit off of its low from 2022 and a bit higher than its low in 2023. I do like Digital Realty as a long-term play on both AI and real estate. However, because of the fact that it uses a lot of leverage and debt, it is a riskier play than many REITs, and you need to keep that in mind if you think about investing in this stock. To follow along in all the moves of all my portfolios and what I'm doing in Bitcoin, you can do so 100% for free at my website, getirk.com. Please hit like and subscribe. It really does help the channel out. And I'll see you in the next video.